There seems to be agreement about the fact that we need a cleaner sort of coming out in terms of what the genuine situation of the fisc is, as also not being overly worried about what the fiscal deficit figure might look like. Sajid, I'm going to turn to you in terms of what your own targets of growth are. And I have, three key numbers, which I'd like to hear what you want to hear or expect to hear from the budget, given that growth target you may have set. One is what you expect to hear in terms of the overall level of government expenditure, the capital expenditure, what figure you expect to see there, and of course, the fiscal deficit, which you've mentioned already. So what is your growth target and what are you penciling in over there in terms of government expenditure and capital expenditure?
Thanks, Mitali. So we actually are a little bit more hopeful than the NSO's first estimate because that was based on patterns till October. And two things have changed since then. One is you've actually seen since November a big pickup in government spending. So the November number was 50% higher than the previous November. December, we don't have the numbers, but if you look at the liquidity patterns, it's another strong month of government spending. So it's good to see. This seems to be a conscious change in strategy that for the next 6 months, there will be stronger government spending, in particular capital expenditure. That and the fact that, India has more successfully broken the link between virus proliferation and mobility than other countries. And you're seeing that the private sector activity levels are pretty much back to 98, 99%. So put those together, and we think growth this year could contract around 6.5%, which is shallower than the NSO's number. And next year, we actually think off that depressed base, growth could go up to about 12%. But however, it's really important to put these numbers in perspective. What does it mean to contract 6.5% this year and grow 12% on that base? Ultimately, we have to compare this to how complete a recovery is this. Where will the level of output be 8 quarters from now, vis-a-vis what we had penciled in pre-COVID? That's your best measure of how complete a recovery India is making. So far, only China was really making a complete recovery by coming back to its pre-pandemic path 6 quarters from now. Now we believe the US as well will come back to its pre-pandemic path in 2022 because we've seen massive fiscal stimulus, and we now expect with the Georgia result another $900 billion of stimulus in the coming months. So even if India were to grow 12% next year, 6 quarters out, the level of output will still be about 4 to 5% below a pre-pandemic path. And that pre-pandemic path was conservatively assessed, assuming growth's about 5.5% before COVID. So we still have a lot of catching up to do. And my fear is we should not make a type 2 error. I think the type 1 error was perhaps we didn't consolidate fast enough after the global financial crisis. Because the economy was doing well, we bounced back rapidly, and the fiscal deficits took a while to come back to normal. Here, the risk is we make a type 2 error, we consolidate too quickly, and we choke off an incipient recovery because our sense is that there's a lot of slack in the economy, there's been a fair amount of labor market scarring. What you're seeing in these 2 quarters is some of it is pent-up demand, some of this is a sugar rush. You're seeing a very bifurcated recovery. The upper end of the income spectrum has done very well. Their incomes have been protected. They've been working from home. They've been forced into saving in the last few quarters. So there's more fuel in the tank, so to speak, for consumption in the coming quarters. And you're seeing that consumption being expressed. But the bottom 30% who've seen their incomes scarred or their jobs lost, that recurring, lingering effect will only show up some quarters out. And I think, therefore, it's really important that we don't, I think it's important to bring the deficit down, I think we shouldn't be too aggressive in the nature of the consolidation. And I think I just want to reiterate the important point that Acharya made, and I'll answer your question in a second, is if you look at this as a share of GDP, what you will see is even before the COVID year, gross taxes to GDP had fallen by a percentage point before COVID. And we're seeing they've fallen by another percentage point in the COVID year. If you net out the excise duties, those excise duties, so higher excise duties on petroleum and diesel have added 0.7% of GDP, which masks how much the other taxes have fallen. My short point is, if the economy recovers over the next couple of years, which we expect, just the regular tax buoyancy in the next 24 months could add almost 2% of GDP in gross taxes to take us back to where we were in 2017, 18. And my own preference is we use that natural buoyancy as a consolidation over the next 2 years. And the discretionary component of fiscal stimulus, which I define to be expenditure to GDP, which has actually grown. We expect will grow 1.5% of GDP this year. I actually think we should protect that next year and possibly even increase that. So we think central government expenditure will end up closer to about 14.7. This year it was 13.2 last year, and the endeavor next year should perhaps raise that by another 0.5% or so. How do you pay for that? In my view, perhaps the easiest in this global environment where you've got so much buoyancy on asset markets is to conduct an aggressive asset sales program in the next 2 or 3 years. So you use the asset sales revenue to finance higher infrastructure. And in a way, this is, think of this as a swap on the public sector balance sheet, where you're disinvesting or doing strategic sales of less productive public sector assets, and you're using that to make needed investments in health, education, physical infrastructure. So use the asset sales to increase expenditure and use the automatic stabilizers in terms of higher taxes to GDP, to control the deficit in the next 2 years. One last point I'll make: there's some misconception globally. Olivier Blanchard keeps making this point that as long as nominal growth is higher than your rate of borrowing, debt to GDP automatically comes down, and the intertemporal budget constraint, is sustainable. But just to add, that is true of developed markets because their primary deficits were actually very low. India will end up with a primary deficit of about 7 or 7.5% of GDP across the center and states at the end of the COVID year. So we can't completely ignore consolidation, because the difference between higher nominal GDP growth and the rate of borrowing will not be enough to bring debt to GDP gradually down without some deficit consolidation. So to summarize, I think perhaps the cleanest approach is increase expenditures, finance by asset sales, use the higher tax revenues and the excise duties that you've got to gradually bring headline deficits down. Because this is still going to be an incomplete recovery, less incomplete than we worried about 3 months ago, but still an incomplete recovery in that we're not back on the pre-COVID path even 6 or 8 quarters from now.